Wonderful. Thank you very much, Tobias. Thank you. I've been doing this for almost 20 years now, and I love it. Very happy to be here. Every year is different, and this year will be different too. This course has an academically correct title, Investment Risk Management. This is the title that was decided with the university. It looks academically correct. It really is a way for me to explain to you what life is about. I've been very lucky in my life several times. One of my fortunate developments is that I created an investment company in 1999. So the company ended during COVID in 2022. But between 1999 and 2022, I had the privilege of being a professor and writing papers and being with the students and teaching and coming to Munich and all of that. But also running an investment company. We had about $1 billion of assets under management. So I got to see the real world from the other side of the window. And when I teach, I try to bring that knowledge to you. This course is rather unusual. I know that, and I take a great pleasure in that. And I want to start, there's going to be a lot of discussion, hopefully, in this course. I want to start with the first topic of discussion, which I need to know who you are. I'll tell you things about me, but we're going to start with you. So I would like to go around the room, giving each of you as much time as you need to tell me why you're here. I want to know about where you're from. I want to know why you came to FIM. I want to know where you're going from here. I want to know where you would like to be 5, 10 years from now. I hope you're not too shy to share that with everybody. This lecture is recorded, but that will be removed from the recording. You don't have to worry about that, because that will help me plan my course for the rest of the week. I want this course to be useful and valuable. I'm not here to make you learn anything. I'm here to help you get to a successful career. But I need to know where you're going from here. So can we start with you? Okay. All right, interesting. So that's a very interesting set of objectives. I'll do my best to help you, okay? So I'll tell you perhaps a little bit more about myself. So you know I'm from the University of Toronto, and I've been lecturing at FIM since 2007, since the beginning. I think I've lectured at FIM every year since it was created. I've also supervised many master's theses at FIM with some of your colleagues, like at least an average of 1 to 2 per year, something like that, maybe 1.5. I created my first company in 1999. I've created maybe 8, 9 companies in probably 6 countries over my career. So I've been very entrepreneurial when it comes to that. I have teaching positions in many universities, Toronto, here, in Kutaisi, Georgia. I'm not sure if you know that university. It's a friend of TUM. At University of Zurich, at Renmin University in Beijing, and probably a few others that at Florida International University, Miami, and probably a few others. So I go around a lot. I used to come to Germany every month. I had a company in Germany. That was one of the countries where I had a company. So I used to come here very often and to teach and to manage my company and this and that. Now the country that I go most often is China. I have several things in China, including an institute that I run. So I know a lot of. I don't speak Chinese, but I have a very active role in China. If any one of you wants to go to China, let me know, okay? In fact, we have an internship program in China right now. If you want to go there, let me know, and we can probably find a way for you to go. Shanghai, by the way, when I say China, I mean Shanghai. It's the part that is most interesting for me. This course that I have here is a little bit different from everything that you have taken before, very likely. And the reason is, this is the course that I like to teach. It's very successful every year. That's why I keep on doing it. If the students didn't like it, I'll change. But the students like it, so I do it. I do know that it is unusual. I don't care. I will be focusing on business and finance. So mathematics and AI is not my objective in this course. It's a tool, okay? Because of that, mathematicians are oftentimes disappointed when they take my course. I don't care. This is the course I teach. This is the course that I think is valuable, okay? There will be some math, because math is a fantastic tool for this, and this is the way this course is done. So mathematics is used as a tool. I will focus as much as I can on everything IT, everything computer science, and everything AI. But I'm not going to get into a lot of that. And the reason is, my experience tells me that you're already pretty strong when it comes to AI and computer science and IT and this and that. And they call them hard skills, and I'm actually not sure. I'm not sure that these are the hard skills. I prefer, and you will see that I'm going to make this course to be very linked to the world, to reality, to what happens in the industry. And that's very hard to get because you have to be there. There isn't a book that tells you how banks work. There's books on bonds and stocks and derivatives, but there isn't a book that tells you how banks work, how they make their money, how they make their decisions, how you have to become street smart. And that is what this course is aiming to do. I want to give you so much information about the industry so that you learn to be street smart, which is very important. And then all your IT and math skills and all of that will become useful. But a lot of IT knowledge without knowing your environment is not very useful. If you're left alone on the Amazon forest with a very big computer, you will die. The computer will be useless, right? It's a little bit like that in the financial sector. If you don't know what banks are trying to do, if you don't know what investment companies are trying to do, it doesn't matter what skill set you have. You will do your job, you probably get a bonus, you just follow instructions, but you will not know what the end goal is, and that's what I want to show you here. There is a course website. I think you've been told. Yes or no? No? Oh, okay. Then I'll show you. There is a course website. What? Yeah, okay. There is a course website which is basically like a multimedia library for you. I record my lectures. I always do. Sometimes I publish them if there's interest. If there's no interest, maybe I don't. It's a lot of work for me to edit this and make it nice, but I do. So we will see if I do that. Maybe I'm going to show you the course website. So that's my website. I pay a lot of attention to my website. It is something that I care for a lot, and that's your. This is just some general nonsense about the course. Okay. The important part is what I call the reading room. In the reading room, what you have is you have the lecture notes, which should be there. There you go. Okay. These are a bit old, but I will update them. Every year, this course is different. And every year, I typically finish my lecture notes just before I lecture. There's always some variation of the previous ones, but I make them more up-to-date, but also more adapted to your objectives. Like, I just learned a few things about you, so today I will edit the second lecture. It'll be different from last year because you're different. Okay? So what you see here is what was here last year. But ideally by tomorrow, everything will be updated. And by the day after, then the next one will be updated. But here you can see maybe 95% of what the scores will be. Every year is different, but not very different. But things are more or less the same. And this is there for your benefit. I'm not going to lecture about everything which is here. There's a lot of material, but it's there. I also have sometimes I run some exercises, and then you have the Excel spreadsheets if we need to do that. I have some, this you can ignore. These are very old now. The YouTube lectures are more up to date. Not for this course. I've never put this course on YouTube. I don't know why. But many of my other courses are on YouTube. So you can go there and there's different things. I mean, it's always me lecturing, so it's always the same style, and the content could be different. But that could be an interesting resource. Then some other things that may matter. And then I have a little bit of a reading library, including some books. Now, in the books, I have some links to the library, but this is the library at the University of Toronto. You don't have access to that. But you could probably find a similar link to the library at TUM. But I probably would have access, but not yet, so I don't have that link. But these are books that are complementary to what I'm lecturing here. And maybe some news items that I will be talking about in my course. So this is what the resource is for you in this course. All right, so that's what that is. Now, in this course, you are not only invited, you are expected to participate in the classes. This is not a European style course. It's more of an American style course. And I guess you understand the difference. In Europe, everything is very passive. Not as much as in China. There is even more passive. Okay, but in America, it's very active. Everybody raises their hand. Everybody has things to say, and it gives rise to a very different lecture style. Okay, so I encourage you to do that. I encourage you to be American when it comes to that. You have to participate. It's better for you. It's better for me. I am very big on discussions. I would like to do a lot of that. I will do a lot of role-playing exercises. I'll put you in positions. In fact, we're going to do that today. Today, we're going to do an investment, a real investment with fake money. But we're going to do an investment today. And that's how I always start my course, okay? And the reason is this. I like to, look, I'm not trying to compare myself with Warren Buffett, but Warren Buffett says that risk comes from not knowing what you're doing. And I completely disagree with that. I like to say that investing is a process which is turning risk into return. So you will be a very bad investor if you don't understand risk, because that's your input. And that's how I see risk. It's not the risk of losing. Risk is an abstract concept. Mathematicians have tried to understand it, and if you talk to a random mathematician what risk is, they say, oh, it's the standard deviation, they will say it's value at risk. Nonsense. These are just different measures of this concept we call risk. But risk is how you make money. I will try to give you a very wholesome understanding of risk. Sometimes we're going to be so lucky that we can have a mathematical formulation. But most of the times, we don't. That doesn't mean that the risk is not there. It's that we don't know how to measure it. And in fact, that is what we will do we will finish with lunch. We will finish with that just before lunch today. Yes, so that's, I don't claim, I'm a mathematician, but I don't claim that I can define risk mathematically. I can't. I can define certain aspects of risk mathematically. Like health. Can you define health mathematically? I can take your temperature, I can define temperature mathematically. I can take a blood sample and I can do a chemical analysis and I can define that mathematically. But can I define health mathematically? No. Same with risk. So in this course, we're going to look at risk as you would look at human health. And some things we will learn, I can measure, but other things I don't. And sometimes the patient knows and says, well, this thing broke down, and why did that happen? I don't know. Do you understand the analogy? And when you're in the financial industry, that's how it works. Right? It's very rare that you have mathematical definitions of risk. Of course, everything starts with the standard deviation. It's 200 years old, and it's been useful for many things. Like probably when you go to the doctor, everything starts by taking your temperature. If you have a fever, that is good information. Maybe you have an infection, right? If you don't have a fever, then probably that rules out probably the infection. But that doesn't mean that health is I take your temperature, right? Very similar. And that's the approach I'm going to take. And because math is only going to be useful when we're lucky, that's where the street smart concept is important, because I want you to understand how the financial sector works and use your own intelligence, your own human intelligence, to be your guide. That's how this course is structured. And I cannot do that in an organized way, which is chapter 1, chapter 2, chapter 3. I can't do that. And that's why I want to start with this, what I call the investment process life cycle. I want you to understand how investment ideas happen, what I call the conception. I want you to understand how they are born. I want you to understand how they grow or how they die. And that's what we're doing today. This course is structured into, every day there will be 2 parts, very distinct parts, morning and afternoon. In the morning I work, and I lecture, and you listen and we interact. In the afternoon, you work. I ask you things to do, you do them, you ask me questions, I help you out. So I want to start my discussion with a business case which is partly true, partly fiction. I'll start with the true part, and then we'll get into the fiction part. And we're going to use this as a way for us to create not just an investment opportunity, we're going to create a company today. And my story has to do with the city of Montreal in Canada. I'm from Toronto, I'm not from Montreal. But my story is from Montreal. And it has to do with something that happened around the year 2000. There was something developed there. It's a very interesting case, which I've decided to use for years and years and years to explain to people what investment really is. The city of Montreal spends over $100 million a year cleaning up the snow in the streets. It's actually pretty close to 200 million. But I'm going to work with round numbers for my example. Let's say $100 million. And the cleaning is done through a public tender process. So every 5 years, they say, who wants the cleaning contract? And then companies bid. Said, I'll do this for that money, I do that for that money. And then the city decides, okay, that's great, you get the contract. And then the way it works is if it snows, they clean it. And if it doesn't snow, the company is just there watching TV. So their obligation is to clean the snow, whether it snows or not. So if you go to Montreal and you see, for example, that truck and that snowplow, they typically they do not belong to the city, they belong to the company. And the company is there cleaning the snow on contract. Okay, that's great. That's very... The thing is, the city needs to make a decision. The decision is which months they want the contract to be in place, because they get charged by the month. You'll be silly to say, I want the cleaning contract to be live in August. Why would you spend $10 million for the month of August when it's 45 degrees. There's no way there's going to be any snow. The month of January and February also beyond question. Of course, you pay the $10 million those months, or 20 million, whatever it is, because you're going to get a lot of snow guaranteed, right? The problem comes in those months when you're not sure. In 2003, in Toronto, not in Montreal, in Toronto, we had a very big snowfall in April. April is not in the contract. Toronto does the same. All cities do the same. April is not in the contract for Toronto, because when we get snow in April, even if it's 10 centimeters, we know what happens. You wait 24 hours, the sun comes up, it melts, so you save $10 million. But that year, 2003, didn't. 3 days after that snowfall, the city was still a mess. And deliveries couldn't happen. You couldn't deliver food to supermarkets. It was a mess. So the city had to call the cleaning company and said, please come and clean this. And Toronto spent 1/2 of next year's budget on one snowfall in April. So you can do the analysis, well, is it worth it? You know, it's every once in a while, I save $10 million. What if every once in a while? So that's a risk that you take. And the cities decide what risk they take because, based on this type of things. And you're familiar with that. Now, the interesting part is this. Someone had an idea. I suspect a lawyer had an idea. The idea was the following. There's a nearby ski resort to Montreal, and they have the opposite problem. In fact, it was also around 2003 where a ski resort near Toronto, at Christmas time, when they're usually fall, they had 0 snow. In fact, it was so hot they couldn't even pump snow. And there were a few children skiing on mud, because they would ski no matter what, but there was nothing. So this is a tremendous loss for the ski resort. Ski resorts, what you see here, that's the ski resort. I mean, the ski resorts in North America are not like the ski resorts in Europe. They make a lot of money. The skiing is not as good as in Europe, but the commercial aspects are much better. And what here you would call a hotel, there is an entire city with maybe hundreds of buildings, which are fully staffed for people to come and ski. And if people don't come, these are huge losses, maybe of the same order as the ones that the city have. But notice that these are offsetting risks, right? The ski resort will be very happy with a big snowfall in April. Very happy, and the city will be very unhappy. So this person came up with an idea, which is to do a snow swap between the city and the ski resort. They go to the city and said, oh, I found a way that if you get a lot of snow in the months which are troublesome, like April, you get paid. But in return, you're going to pay a little bit to someone else every year. You do go through the analysis, oh, it's worth it. I'm happy, I like it. And so if there's no snow, the city will pay some money to the ski resort. I pick up a number at 10 million so that these numbers do not, they're not real. Okay? But we're going to use them today for our purpose. Our purpose is not to clean up snow. Our purpose today is to come up with an investment opportunity. So I want to use these numbers because they give rise to an investment opportunity which is easy to understand. That's all. And then you talk to the ski resorts and convince them that if they get a lot of snow, then they will just give money to the city. And the ski resorts are, sure, that's fantastic, because that decreases their risk. We can't, to your question, we can't quantify what risk means, but this is a concern they have, and this minimizes their concern. Is this something that is a good decision? Well, we'll have to do some analysis, but I'm not doing that today. This is not the business case that I'm interested in. I'm not interested in either the city or the ski resorts as my business case. I'm interested in having their problem built in my business case, which I haven't done yet. So in the end, they drafted the contract and they met for the signatures one day. And then when they're about to sign, one of the lawyers made an observation. He said, wait. There's a clause missing. In the contract, it never specified exactly where they would measure the snow event. Oh, that's easy. Let's just write the city, corner of blah, blah. So what? No. The ski resort didn't want the measurement to be in the city. It has to be at the ski resort. And then the city said, no, it cannot be the ski resort. It has to be at the city. Yeah, ski resort city, they didn't agree. And this thing was not signed. And this snow swap never happened. So this is true. It's a true case. And I want to use this as an example to build my investment case. So you understand this, right? This is the backdrop. And that is, in a certain sense, waste. There's a missed opportunity. Because this deal was not signed for something that looks very silly. They couldn't agree on where to measure. And if you think about that, that should not be that big a deal. This is Montreal and a ski resort 100 kilometers from it. This is not Montreal and Munich. This is not Montreal and Vancouver. So there should be a way to make this work. So what I decided to do is, I say, well, this is fiction. Let's say I am there. I am witnessing that meeting. I'm a guest for whatever the reason. So I said, wait. No one leaves. Please take a seat. I have a proposal for you. This is my proposal to them. Okay? My proposal to them is this. You, city, ski resort, I will sign a swap with you exactly as you want it. You specify your measurement station at the ski resort, and if there is snow, you pay me $10 million, and if there is no snow, I pay you $10 million. And then you, city, you decide where you're going to measure this. Pick your corner, pick your observation station. I do the same swap with you. If there is snow, I pay you, and if there's no snow, you pay me. And I want to charge you some money for that. I pick 10% of the cash flows because 10% is an easy number. They may say, 7.5, 3.5, who knows? 10%. I just want you to understand an investment opportunity and everything that comes with it. Yes? All right. What do you think of this? That's my first question to you. I'm going to make $200,000 a year. I mean, I'm using these numbers. Okay? 10% of, actually, no, this is $2 million. I'm going to make $2 million a year for participating in two swaps, 10 million and 10 million. Under normal circumstances, it snows and snows. So I take money from one, I give it to the other, and I keep $2 million. I don't know who's going to be the receiver, who's going to be the payer. I don't care. I will make $2 million. The problem is, there may be some years in which I have to pay both. I lose $20 million. But there will be some years, I think, where they both pay me. There's no snow in the city and there's snow in the ski resort. They both pay me, and I make $22 million, right? So that's my proposal to them. What do you think of that proposal? Do you like it?
It depends on the correlation between the two, right? Like if I think
okay, so you just said something. So thank you for that answer. That's a great answer. You just said a magic word. You said correlation. Yes? Because you're a mathematician and you understand about correlation a little bit. So that will be my starting point. Okay? So that you gave me a very nice way to think about that. So imagine that I have a clock there, that I push the button, and then everything, time stops. I said, oh, wait, everybody stay there. I'm going to go and I'm going to talk to my friends here. And I want to see what kind of a deal we can do. So let's try to quantify that. And for that, what I want to do is I want to analyze this to the best of my abilities as a mathematician. So I want to assume a correlation, as you said. And I'm going to assume a 50% correlation. Why? Because 50% is a very easy number. The correlation is higher than that, but I don't care. I'm just doing this to explain to you how we think as investors, which are mathematically able. With a 50% correlation, I can give you the following cash flows. 75%, do you know about correlations? I want to define correlations for you, don't worry about that, but I assume you already know correlations, at least a little bit. And I'm not sure how good you are, but if I have 50% correlation between these two events, the probability that I get from one and give to the other is 75%. I don't know if you knew that. This is a Bernoulli random variable, 4 events or 2 correlated events of 2 each. 50% correlation means 37.5% both go up, 37.5% both go down, 12.5, 12.5. Okay? You could do that in your elementary probability course. You've done things more difficult than this. So I'm going to assume that this is, maybe you did not know this number, but I'm going to assume that you understand where this number is coming from. I'm going to assume that if I change the 50% correlation by 60% correlation, you can tell me what that 75% would become. 64. It's bigger. Sorry? So it's 64. Oh, well, you have a very fast calculator right there. I don't know what the number is. But if that's 60%, that 75 is higher. Right? If that was 100% correlation, this number is 100%. I know that. Okay? So if the correlation is higher, that number is higher. I know that. What it is, I don't know. But you have a very fast chip there. My chip is slower than yours. Eh?
It's made in China.
It's made in China. Okay, there you go. Oh, but it's made in China a few years ago, the ones made in China are faster. Okay, so there's also a 12.5% chance I receive payments from both, and there's a 12.5% chance that I pay to both. So that's what the mathematics will tell me. Is this a good deal? This is very unusual. I can tell you the probabilities of the cash flows, right? Very unusual. Usually we can't do that. And now we need to make a decision whether this. So he's first. Jan, that's right. Jan.
So I would say in terms of the expected payoff, it is a good deal. I think it also depends on your cash reserve. So if the 80 million would mean that you're bankrupt, then that might not be the best idea because it's just a gamble at some point. But if you have the reserves.
Okay, so you brought up another mathematical term, the reserves, right? So slightly we're beginning to bring the math into the considerations. Jonathan? Yeah. No, what's your name? Jonathan. Okay, yeah.
Yeah, I mean, as Jan said, from the expected payoff would be profitable, but you have to make more assumptions. I think it's not enough to just calculate the probabilities.
Okay, so let me do something. I'm going to come up with the investment parameters. And this is how you look at every investment opportunity you make. There's some basic investment parameters. Basic. We're going to do many more here in this course, but this is how we start. So first of all, the invested amount. How much money do we have to invest for this? I would say 20 billion. Why?
You will need to pay for both sides if you have.
That's my total maximum liabilities. Okay, if things are worst possible, then I will need 20 million. So 20 million. Okay, yes, we agree on that? Anybody disagrees? Let me disagree. Why do I need 20 million? Why don't I just sign the contract? The contract costs me nothing, right? Why can't I sign the contract without any money? Why is this number not zero?
Do you have the financial obligation to pay it later?
It depends on them. If the city and the ski resort are stupid enough to sign this without me putting down any money, great. What happens if I have to pay 10 and 10? I go bankrupt, fly to Brazil, and I still have 2 million, right? So, no? Don't laugh, this is how things work. So here, I'm assuming I need 20 million because they have very smart lawyers who said, no. I need to see your 10 million. In fact, I need your 10 million to go into a escrow account. You cannot touch it. And it's there because I need guaranteed payment. So you go to a bank, Wells Fargo, you keep the money there. The lawyer verifies the money is there. I cannot touch it. And that is proof of payment. Or they say, well, you need some collateral. So I take my castle in France as collateral. It's worth 20 million. That will be different, right? Because then I put collateral, but that doesn't really cost me money. So there's many ways to structure this deal already before we got started. But I'm going to take the simplest approach. I'm going to say they require 20 million in cash. They don't trust my French castle. You understand? Okay, so it does cost me 20 million, that's why. So in saying this, I'm making an assumption which is really a function of their aggressiveness when it comes to doing this deal. Okay, the average return is 10%. You already went through that, you already told me that's a very good deal. By the way, the 10% is not accurate. That's 10% assuming interest rates are zero. If interest rates are 5%, it's going to be 15% because the money in the escrow account collects interest, and that's mine. So the 10% gain is just my fees. It does not include my interest. Understand that? This is very important because for a lot of this course, we're always going to make a distinction between return and return minus or plus the risk-free rate. The risk-free rate is always there somewhere. It's easiest to ignore it because everybody knows what it is. This is just given by the markets. But you have to know when you have to add it, when you have to subtract it. One of my favorite mathematicians, Erdős, probably one of your favorite mathematicians too, he had a very good sentence. He said, you know, I'm a mathematician, and many people think that because you're a mathematician, you can calculate very fast on your head, right? It's happened to you too. He said, a mathematician is not someone who knows how to add. It's someone who knows when to add. It's a very good sentence. Very good sentence. So when it comes to finance, I would extend that sentence and say, you need to know where the cost of money is. So this is 10% plus the cost of money. Yes? So this, but I'm also going to leave that aside. I'm going to leave a lot of things aside because I want to get to the business. But these are things that I should know. So the average return is 10% plus the risk-free rate of return. And then I'm going to include the volatility. I'm going to include the volatility here. You already know what it is. We're going to spend a lot of time dealing with this. And of course, as we will see, it's a very poor description of risk, just like taking the temperature is a very poor description of health, but it helps to get started. And you know what the volatility is here. You can go through that. There's a 75% chance that I'm exactly at my mean. This is a 12.5% chance I'm 110% away from my mean. And there's a 12.5% chance I'm 90% away from my mean. Result, I get a volatility of about 50%. Are you following me? Good. So with a rate of return of 10% and a volatility of 50%, there's this quantity you may have heard of, which is the Sharpe ratio, which we're going to spend some time talking about, which is 0.2. And 0.2 would typically be considered to be a very low number. We want that number to be high, right? High return, low risk. So we typically would say that this is not a very good deal. So that's a bad deal too. So why did I propose that? I propose that because I'm a very good investor and I know what I'm doing. This is a bad deal. I know that. Now you know that. But I also know that I can do this deal 100 times over. I can go to 100 cities in North America and 100 ski resorts and do a similar deal with every one of them. So I started in Montreal, but then I can go to Blue Mountain in Toronto. I can go to Mountain Creek in New Jersey. I can go to Panorama Mountain in Calgary and this and that. So I can do 100 of these deals. Yes?
It says on the slide that the cash flows are independent, but are they really dependent?
That's a very good question. That's a fantastic question. So are the cash flows independent or dependent? Let's say, what would global warming have to say here? Let's say the world is getting warm. There's no question about that. Let's say that...
I would say global warming would say that it's not independent because it makes extreme weather events much more likely.
Okay, but let's say that the extreme weather hits cities and ski resorts the same way, right? So unless you're talking about a very unusual meteorological event that suddenly snow is driven away from mountains and into cities, then extreme weather events should affect cities and ski resorts the same. So it should be hedged. I know this is a very important topic now, because now we need to understand what that might be, right? I mean, am I really sure that these effects will hit both cities and ski resorts the same way? And by the way, sure is something that we rarely use in finance because we're talking about always the unknown future. But it looks pretty plausible that the cash flows are somewhat independent, right? So if I assume that let's assume in fact that the meteorological events affect both cities and ski resorts the same way. We've made a lot of assumptions so far. This is another one that I'm making, which I really cannot quantify. So then it's perhaps fair to say that I don't care if because of global warming, I will be getting a lot of money from a lot of cities and I'll be paying a lot of money to a lot of ski resorts, as long as I don't have mismatches happening more than I would expect, which is about by the square root of the number of deals, which is 10. Jonathan?
So definitely it would make sense to do the same deal multiple times.
Yes.
To diversify the risk.
Yes.
And I mean, if the cash flows are independent, perhaps you can model it with a normal distribution.
Okay, there we go. Yeah, that's exactly what you're doing. That's exactly what we're doing, right? So, so let's look at the investment parameters now. The investment parameters is the invested amount is now $2 billion. I'm going to assume that every city and every ski resort have very fierce lawyers who insist that I put down the money. right? The average return continues to be 10%, and the volatility is now 5%. If I model this with a Gaussian, then it'll be 5%.
Why Gaussian, not t-distribution?
Because I have 100, and the central limit theorem tells me that if I have a large number of independent, identically distributed random variables, they converge to a Gaussian.
And then in our modeling, don't we ignore this tail risk?
Okay, so now you bring up the tail risk again, all right? So it's another modeling question. And if the central limit theorem is correct, there's no tail risk. And you say, oh, how innocent of you to think that, right? Of course, there's always tail risk. There's always things that could happen. And you're right. But I'm there. I mean, I put my stopwatch and everybody's waiting for me to make a decision. And I'm a professional investor, so I need to decide something very quickly, right? Of course, then I'll go back to my team, which is you, and said, oh, but what do you do? Why do you do that? Well, I had to do something, right? If the ski resort and the city leave that meeting, they're never coming back. So I need to do something, right? So you're concerned, you're concerned, you're concerned. You're giving me concerns. And you're right in your concerns. But I need to do something. So I decided to go ahead with that. I have a Sharpe ratio of 2. I'm very happy with that. And you're thinking, you're a fool because you're taking the Sharpe ratio of 2, but there's this risk and that risk, and you understand what the risks are. And I understand that you understand. But I said, I had to make that choice, right? So this is my situation. I have all these swaps in all these places. This is my investment portfolio. I have a very good Sharpe ratio. And I just agreed to do that. Okay? You understand? So I agree. I said yes. I said yes. Now, some of you would ask me, well, do you have $2 billion? I say, no, I don't have $2 billion. Do you have, anybody has, how much money do we have? Do you have $2 billion? Do we have $2 billion?
Close.
Close? Okay, no, I don't have $2 billion, but I have friends who have $2 billion, which is the next best thing, right? It's always better if you have the money. I don't, but I have friends who have $2 billion. Okay, so let me, so if I have friends with $2 billion, what shall I do? I should just call them. No? Which are my friends that have $2 billion? Let's make a list of our friends with $2 billion. Who do you know who has $2 billion? Listen.
Professor Sachs.
Okay, Professor Sachs, we'll write that name there. Any other names which are more likely? Warren Buffett, okay, yeah, any other name? How about Allianz Global Investors? Do you know these guys? Yes? Okay, let's write them down. Okay, Allianz Global Investors. They have, how much do they have? You have to know these things. How much money does Allianz Global Investors have? Can you check? Do you have your ChatGPT handy? Oh, you have to use ChatGPT in my course all the time. It should always be running, okay? Or equivalent. I don't care, you use DeepSeek or Gemini. I don't care, but something. You need to know these things. If you don't know these things, then you're lost. AGI, what's their assets under management?
580 billion.
Okay, 600 billion, right? Of course, it goes up and down every day. Let's say about, so do you think we could convince them to give us a little bit? What do you think? Anybody knows them? I can talk to someone. I can talk to Tim Friedrich. He was here in the year 2008, right here. So maybe he still remembers me.
And if we can convince them that it's a good idea.
Sorry?
If we can convince them it's a good strategy.
Okay, well, let's come up with that. we need to learn how to convince them. So we need to learn how to sell these things, right? So we'll talk about that too. So AGI, that we have some hope there. Probably better than Professor Taxt. Yes? Any other names? Do you know MEAG, Munich Re Asset Management? How much do they have? Okay, maybe they can give us a little bit. Good. Who else? BlackRock, okay. How much do they have?
Minimum 3 times now, even more.
I think it's 17 trillion. So I think it's 17 trillion. They are 3 times Germany, 4 times Germany.
11.6.
How much?
11.6 trillion.
Okay, only 11.6. So they are only 3 times Germany, 3 times the GDP of Germany. But maybe they can give us something, you know. So, shall we continue? So we have some friends, you know, Siemens Pension, Asenacon, and we have a list of companies out there. Just call them up, you know, right? Just in Germany. So there is some hope. So how does it work? We just call them up and ask for money, or how does that work? We have no money, 0. Okay, 0. I can barely pay for my trip to Montreal to talk to the lawyers. I can fund that, but that's it. So what do we do? How does this happen? We call AGI and we tell them that we have a great investment opportunity, see if they want to give us any money. Is that how it works?
They ask how much they get out of it. If they give you the money, then they want to have something.
Okay, so actually that's not how it works. The way it works is you need to have a fund. So let's talk about a fund. You know what a fund is? There's only one legal way to ask people for money to invest. You need a fund. If you do it without a fund, you're actually breaking securities law. Me giving you money is very highly regulated. The tax authorities will get into that, the consumer protection agencies will get into that, BaFin will get into that, say, whoa, what's happening here? You're giving money to them for what? Is that income? Then you have to pay taxes. If Allianz gives me money, depends for what reason, then I have problems with the German tax authorities because I have to pay taxes on that, right? Now, when you give someone money, anybody invests here? You invest. Do you pay taxes when you invest in? How do you invest? You go to the bank and you give money, right? Yes. You pay taxes?
Yeah.
No, you don't. No. Hold on. You may pay taxes on the capital gains. But when you give 1,000 euros to, say, Deutsche Bank, you don't pay 20% of that to the tax authorities, right? That 800 goes into your fund and 200 goes as tax paid, right? Because that is not, every transfer of cash needs to be regulated. So if you give money to the bank because it's income for the bank, then either you or then someone's going to pay taxes. But this is not income, you're making an investment. Investment, you don't pay interest on that transaction. For that, the destination has to be a fund. You don't pay money when you invest in the fund. When the fund pays you money back, then you pay taxes, but not when you invest in the fund. All of these things are regulated. So you need to create a fund. What is a fund? Do you know what a fund is? A fund is a legal structure which is designed so that investors can put money into it. And this is regulated. All countries, most countries, all countries regulate this. You can have funds, right? But a fund has to be defined according to the laws of that particular jurisdiction. I would bet money that if we do this fund in Germany, this fund would be illegal. Because I'm pretty sure that Germany would only allow funds which are like mutual funds, this and that. A fund which takes money and invests in snow swaps is probably not allowed. Why? Because this is probably not an allowed security within the German, in the BaFin regulation. So I would probably have to send this fund outside of Germany. Ireland? Actually, most funds go to Cayman. Cayman is the biggest destination because Cayman will allow you to do just about anything, which is legal. One of the advantages of Cayman is they have British law. And British law is the best, to this date, the best, most accepted law system that exists. All of these things were done around the year 1700 because all of these things were created as a consequence of the Industrial Revolution, which started in England. And they still, to this day, they have the best regulation. No one has had better regulation than them, not the United States even. And Cayman is British territory, yes.
When you say best, is that your personal opinion or like based on what factors do you say it's the best system?
Most efficient. It's the one that normally I have a whole chapter on offshore investments, and I discuss every jurisdiction and the advantages and disadvantages. Okay, so in this course I don't have that, but now we are hit with that because this is very important. Very often you need to take your investments offshore. Like you don't have a choice. You have to. In fact, many big investors, they cannot invest in onshore accounts. For example, the Canadian pensions. Canada has perhaps the best pension plans in the world. They cannot invest in Canadian funds. Because if they invest in Canadian funds, they are subject to tax withholding. And these are tax-free or tax-exempt pensions. So they cannot invest in this because then they have to go and get the tax back. And that's an incredibly difficult process and very long. So you invest in, say, a Cayman fund that has no tax withholding, and then there's no problem. So the location of this fund is very important, what's called the domicile of this fund. So this fund, if it was up to me, I would put it in Cayman. Everybody can invest, there's no tax withholding, and then people will pay taxes in their jurisdiction without a problem. And I have a very sound legal system. By the way, Cayman has wonderful service providers. You want a Cayman law firm? They have the best. Do you want a Cayman bank? They have the best. You want a Cayman, we're going to see the service providers, they're coming up now. They will be at the bottom of this diagram. They have the best. But if my investors are, say, German companies, then I cannot put them in Cayman because Germans hate investing in Cayman. No, it's not that they hate, it's that the German tax authorities hate when Germans invest in Cayman. So they will make your life miserable if you invest in Cayman. It's not illegal. They will make your life miserable. So they don't invest in Cayman. So I go to Luxembourg, the next best thing. So if I'm going to do a fund where my investors are German, then I go to Luxembourg. If my investors are Chinese, I go to Hong Kong. If my investors are from the Middle East, I go to Dubai or London. If my investors are from Latin America, Cayman. Okay? So we need to know those things. It's very important. But right now, I'm not going to talk about that. But I do need to create a fund. Otherwise, there's no way. Even if Allianz Global Investors, this is a fantastic investment opportunity, how do I invest? I say, well, wire the money to this account. I say, what? I cannot do that. You need fund and fund documentation, otherwise you're breaking the law. I'll show you what the fund documentation is. We're going to learn that today too, because we are going to create a fund before lunch, I hope, okay? Now, with the fund, I need to create an investment company because the fund has a very important service provider. The most important service provider is the investment company, is the management company. The management company is what? See, the fund is the one that is going to be signing the swap agreement with the city and the ski resort. You understand that? But who's the fund? Do I have to go and ask all my investors, AGI, MEAG, and this and that, and Siemens Pension, to sign every time we do a contract? No. What they do is they give the management company the rights and responsibilities of those signatures. So the management company is in charge of the fund. They manage the fund, right? So the management company will have a signing authority, say me, then I signed, but I don't sign for the management company, which by the way is my company. I signed for the fund, because in the contract between the fund and the management company, it says that the management company can sign. You understand? Good. There's going to be other service providers. I need a bank, I need a broker, not for the snow swap, because I don't need a broker, but if I buy and sell stocks, I need a broker, right? Then I need an administrator. The administrator counts the money. That's what they do. KPMG, for example, they count the money. And they tell my investors that their money is there, and they say, well, these are the assets, and you put $1 billion, guess what? Yeah, now you have 1.1. And they say, no, I don't say it. They should never believe what I say. Right? Why would they believe me? They need to believe an independent party. And not only that, there's also an auditor that goes and checks that the administrator, what they said is right. So there's 2 layers of oversight over what I do as a management company. And all of these have to be conflict-free, which means I should not be the administrator and the auditor. I say should not because in most jurisdictions, I am. Has anybody invested in a mutual fund by, say, Deutsche Bank in Germany? If you invest in a mutual fund by Deutsche Bank, who is the management company?
I think they're in Luxembourg.
Hmm?
I think their fund management is in Luxembourg.
It's Deutsche Bank.
But Deutsche Bank, Luxembourg, right?
Probably, but it's Deutsche Bank. It belongs to Deutsche Bank. Who's the administrator? Who decides the value of the investor's money? Deutsche Bank. Who checks that Deutsche Bank's numbers are correct? Deutsche Bank. Gets more interesting. Who's the bank?
Deutsche Bank.
If they have to buy and sell stocks, who's the broker?
Deutsche Bank.
More interesting even, the broker charges a fee. They don't do brokerage services for free. The administrator charges a fee, so does the auditor. Who decides the fee?
Deutsche Bank.
Who pays for that fee?
The investor.
Exactly. Do you think the management company negotiates in favor of the investors? Yes. That's what they say. Okay? Now, that is not conflict-free. Now we get into a very important topic. I'm not talking about that in this course, but I want you to be aware of this, because that's how these things work. Okay? In Deutsche Bank's defense, these things are regulated, and BaFin checks everything, that fees, right? Sure, yes. There's a police officer called BaFin that checks that this structure, although it's conflicted, it's fair. So BaFin checks for fairness. Sure. Yes. You understand what I'm talking about? Okay, so are we ready to do that? By the way, the fund has additional layers, which not too important for us. So I have service providers and I have the owners, and they have very different roles in that. And then we have the directors. I'm not going to talk about the directors here. If I have investors in different jurisdictions, then I have what's called a master feeder structure. I will have a master maybe in Cayman, but then I have a feeder fund. A feeder fund is something that I set up in Luxembourg for German investors. I have another one in Hong Kong for the Chinese investors. And then in the end, everyone invests in my master fund. And investors are just grouped into whatever it is that is best for them to invest. And then you have a wonderful cathedral of investment structures, which is how these things actually happen. $2 billion is a lot of money. Okay, so to do that, we may have to do something interesting. But let me go to the part which is perhaps more interesting, which is, why are we doing this? Why am I getting into this trouble? I went to this meeting, I make this proposal, I go to 100 cities, and I talk to 100 ski resorts, I do 200 contracts. Why? So I can teach a course in Munich at FIM? No. Why am I doing this?
I earn a fee.
Exactly. How much?
I mean, on the slide it says 1% of assets and 10%.
That's good. No, that's why it's there. So I do this because I have the hope of charging 1% of assets and 20% of net gains. But the fee could be something different. Of course, if the investors are happy with this fee, then that's great. If not, not great. And this fee goes to whom? To me? No. To the management company. The management company is a service provider to the fund. The management company works for the fund, so this money goes to the management company, right? Great. So this is the fun part, because this is the money part. This is the real money part. So let me now give you a table that talks about money. First, the money which is invested. The investors invest $2 billion. The manager invests nothing. A tiny bit. I have to rent an office and hire some people. Yeah, but okay. After a year, I will have some what's called gross investment gains, which is that 10% that I said I was going to make, right? Yeah. So that's $200 million. But that's for the investors. That belongs to the investors. But then I have a fee. You can see. Am I in the middle?
It works.
It works, okay. Maybe I should put it over there. Okay. So the investors get charged $20 million, which goes to my company. And then they will pay a performance fee, which is 20%. It says it's right there. So 20% of 200 minus 20 is 36 million, which goes to my management company. That gives a total gain to the investor of 144 million. 56 million comes to my company. And then that gives a net profitability to the investor of 7.2, not 10. And of course, I didn't put any money, so I make 56 million. It's an infinite amount of return. Okay, so let's look at this for a little bit, because I am ready to do this. This is a good deal for me. I'm going to make $56 million. And my investors are happy with 7.2 plus 3 interest rates, right? I want to do that. But to do that, I need to hire people. So who wants to work for me? You guys are not going to be successful. I know the successful people are the ones who raise their hand very quickly. Always. Take that as a piece of advice. If there's one thing you should learn from this course is raise your hand first. No matter what the question is. Okay? So who wants to work for me? It's still only one person. Okay, what can I do? I'm not lucky this year. Okay. So so what kind of people do I need for this? Can I do this alone? No. This is managing money is a lot of work. And I want you to learn what that is. So right now I have Jan, only Jan wants to work. So I'll be the CEO. Okay? What job do you want? You pick, because you're the only one who wants to work for me.
Honestly, I think I would be good at investor relations.
Investor relations, fantastic. Okay, great. So you're going to be in charge of investor relations, marketing, sales, all of that, right? Good. Okay. How much shall I pay you?
How much are you going to pay me?
Well, I'm asking you.
So I would.
This is real. I mean, I'm not.
Yeah, I would love to have a base salary. Let's say 250K a year, and then a performance bonus depending on the profitability. Let's say, I don't know. Yeah, 100% of my base salary, and in charges depending on how profitable.
No, tell me. I want to know. Give me the whole thing. I'm still listening.
Yeah, okay. Let's say 250K base salary and another 250K bonus
If you meet targets.
Say again?
If you meet the targets,
Yeah.
yeah? You're cheap. Of course you're higher, but you're cheap.
Even for an investor relations person.
You're cheap.
He's just out of university.
You're cheap. You're cheap. No, you're very cheap. Look, I'm happy I hire you, but you're cheap. See, which column are you related to? Which column are you talking about?
But the right one, the profitable 56 million.
No? No. Which row?
We can't see it.
You bring me the management fee. That's what you bring me. You give me row number 3. You give me row number 3. So you're telling me you're going to bring me $20 million and you're going to charge me 500,000? Thank you. You're hired.
I'm not going to be the only person that's necessary, right? So
What? No, of course you're the only person. How many do I need? How many clients do I have?
I think on the
4,
slide
10?
before we had 4.
You're cheap. Thank you. That's good. You're hired. Okay? You're hired. That's good. Okay, so I need my customer relations person. That's great. Good. That's it. I need more people. But I don't know if I can change your mind about working for me, but I need a lawyer. Who wants to be my lawyer? You want to be my lawyer? Your name again? Yuan Chin. Yuan Chin. Okay. You're my lawyer, Yuan Chin. Good. How much do I pay you? By the way, this is important because I need you to understand one very important thing, which is your salary. You always need to look at your salary the same way. Look where your salary is coming from. You don't understand that, you cannot negotiate. Okay? So 5% of the management fee. 5% of the management fee. That's $1 million. So you want $1 million. Or you want 5% of the management fee, meaning if the management fee comes down, then
With a floor of 250,000.
okay, so maybe this is what I do. It is very unusual to pay a lawyer based on the amount of money I raise, right? Imagine this situation. I would not do it, okay? Not like that. I'm happy to pay you $1 million. I'm happy to pay you $2 million. But I would not pay you like that. Imagine that you're in the situation where the city of Calgary is very aggressive on their contract and they say, I'm not going to sign this unless these stupid questions are agreed upon. What do you do? They're stupid questions. It's stupid demands on the city of Calgary. What do you do?
Try to answer them? Try to answer them?
No. No, it's like this is what's called a poison pill. Look, it's either this, take it or leave it. What do you do? Leave it. I mean, I pay you to sign, right? Right?
You're asking, okay, as a lawyer, then I will take
So you say, how can I say no? I mean, I'm losing money if I don't sign this deal because I pay you on success, right? So you are encouraged to sign, even if their conditions are stupid. I cannot pay you based on performance. I'll give you $2 million, but I'm not going to pay you as a function of that. I do not mind paying you as a function of that. That I don't mind. I can give you a little bit of that. I don't mind. Why? Because maybe you help me negotiate a very good deal so that my performance fee goes up. So you see, I cannot pay you for that. I can pay you for that. But normally a lawyer, I'll pay you $2 million. And thank you. $2 million is a very good deal. Good. So I got my lawyer, Jinchi, and I got Jan. He's my relations officer. I need a very important role, which is actually required by law. I need my chief investment officer. If I don't have a chief investment officer, I cannot open the fund. It's not allowed. So I need an investment officer. Who wants to be my investment officer? You guys don't want to work, I know that. You just want to live the good life, you know? You want to be my chief investment officer? So Jonathan, right? Jonathan is my chief investment officer. Great. How much shall I pay you? How much? We're talking about money. 2 million base? I can see that you're learning something. Look, I can see that. That's good. 2 million base and, or just that? What?
10% of the investment gains?
10% of the performance fee, right? 10% of the. Sure, I accept. It's tough, okay? It's about the maximum I will accept, but let's say yes. By the way, yeah, and you see that you undersold yourself.
Yeah. I was the first one making the mistakes.
No, but look, you came here to learn, and I came here to teach you. I can see that it's working. This is a good skill. This is how you find what your salary should be. Oftentimes people come and ask me for advice, students, when they go and get a job. And they ask me, shall I ask for this? And they say, well, how much money is behind that? I said, they don't know. Well, go find out. Right? It's always easier if you know where the money is coming from. Jonathan.
Regarding salary, I often hear two different things about negotiations. One thing that you should say more than the average of the industry, and another thing is that you don't give a number immediately.
Okay. I have a whole course on negotiation skills. Okay, this is not it. I'm happy to do that later. It's much more complicated than that. These are tips, but I want you. If I talk about that, I should give you the whole story. Okay, the whole story. Yeah, but so right now I'm not aiming to teach you how to negotiate your salary. I'm aiming to get you to think about your compensation the right way, which is understand where the money comes from. And it's difficult because when you do that, you're not thinking about you, you're thinking about them. right? Your mistake, you're thinking about you. And in this case, you undersold yourself. Right? You're thinking, wow, it'll be great if I make €500,000 a year. It'll be, and you think it's good. No, it can be much better, right? Because you're thinking of you, you're not thinking of me. If you think of me, you can make much more money.
I mean, I was thinking about you because I wanted to maximize your return. So.
No, I don't believe that. But I can see you're very good with customer relations. Okay, so I got my chief investment officer. By the way, you know you have a lot of risks here. If something goes wrong, you go to jail. If you break the law, right? That's why I don't mind paying you that money. Yeah, sure. Yes, right? Yeah? Okay, so Jonathan is my chief investment officer. So I got my lawyer, I got my chief investment officer, I got my person in charge of customer relations. What else do I need?
A salesperson?
Well, that's him. Okay. I have one. If this was a very big, fund, a very big operation, I'd probably need more than one. But in this case, I just need one person. That's him. Do you want to work? Do you want to work for me?
Of course.
Oh, what do you mean? Of course, you never rose your hand when I asked. I asked several times.
I mean, when I heard the salary, now
It's always like that. It's always like that. Okay, so what do you think you can do for me? Now you have to sell me now.
I will be the chief of ski resorts.
The chief of ski resorts. Okay, so so let's see. Who deals with the ski resorts? These two people, right? So when it's time to negotiate with, say, Whistler, then you two guys, you fly to Vancouver, both of you, and you go and negotiate with them. He negotiates on behalf of the fund the economic conditions, and you negotiate the legal conditions. So that's my negotiation team. They go. They deal with that. And by the way, while you fly to Vancouver, you negotiate with the city of Vancouver about the cleaning up of the snow and everything. And same thing, he negotiates the economic deal, you negotiate the legal deal. So I got my team.
But the operational stuff is still missing.
What operational stuff?
Like organizing who is planning what.
Ah, well, I need a chief operating officer. Okay, you want to do that?
I would.
Great. Okay, you're hired. How much will I pay you? By the way, what do you do? What's the job of the chief operating officer?
Managing the two sides, the ski resorts and the city.
No. You have to send these guys to Vancouver.
That's an easy job.
You have to see if this guy is having all the conversation with all the investors and say, oh, did you respond? Are you sure you did that? You have a very important role. You're the one who takes care of all the operations. So how much?
I think you're very dependent on me. So then I can't directly say if my...
Okay, I'll make it easy for you. I don't know if you're trying to sweet talk me into something or you're actually, I don't know. But look, there's no sweet talk me into anything, okay? Where are you?
Yeah, this is actually the question I'm thinking about, like where I'm referring to in the fee context. Like both are under performance fee. So if I manage them, then I'm responsible for the performance fee as well.
So maybe you want then that.
Yeah.
How much of that do you want? I don't mind. I think for you that number is the most relevant. Yeah. Always a base and always a performance fee for you. What's your base?
Yeah. So I was just thinking about my risk, and my risk is pretty low actually.
Your risk is zero.
Yeah, which is quite nice.
Very nice. His risk is high. So I cannot pay you more than him. There's only one person I will pay more than him. Him. the cheap guy. Why? Because without him, we're nothing, right? Even he would be in favor that I pay him more than him. Because without you, right? Look, you came here to learn. That's okay. That's okay. But yeah, your risk is very low. But yet your pay could be very high. I mean, I would not pay you more than him, but I'll pay you more than her.
Okay. Women are always underpaid.
Oh,
No, just joking.
no, I'm going to have some legal actions.
Yeah, I take your lawsuit. I take your offer.
Okay, so that, well, some number there, like $1 million flat, and then maybe 5% of the performance fee, something like that. 5% of the whole revenue of the firm, or something like that, right?
Better than I expected.
Look, so am I done? Do I need more people?
HR,
Hmm?
HR, human resources.
No, HR, no. I don't need HR. No. I'm not going to hire one person to manage a team of 5. I do that. It's a very important role missing. Very important role missing. Very important role missing.
Maybe an analyst?
Analyst, that'll be his decision. So he hires the analyst. That'll be up to Jonathan. He may want an analyst or not. No. This is a very important person. I need a chief financial officer. How can I manage this without someone who counts the money? Right? I need a chief financial officer. Very important. I'm surprised no one sits.
So there's a big differentiation between the investment officer and
Oh yes. His job is to make money. The other person's job is to count the money. He needs the CFO. He's not going to spend time counting the money. How much money is here? No, that's a distraction for him. Anybody wants to be my CFO? I'm losing faith. I mean, you guys, you gave me all these objectives and goals of what you want to do, blank sheets of paper. They're still blank. I mean, you need to fill them with something, Anybody wants to be my chief financial officer? Sophia, can I convince you? No? You were there. I mean, should I not?
Yes, you will.
Yes?
Yes.
Okay, good. I have a chief financial. Without a chief financial officer, I cannot launch this fund.
But the risk is also high, right?
Eh?
The risk is also high.
No.
No.
Well, first of all, I'm surprised that you think about the risk that you have as an employee. I'm surprised. Okay, that's not. But second, no. The chief financial. What's the risk? Are you planning to run away with the money?
Who knows?
Well, then that's a different type of risk, right? No. But I give you one piece of advice. Take risks. Take as much risk as you can. At your age, that's what you do. Take risks, yes. Don't be European. At your age, risk is a good thing. Risk that pays, but you have to take risk, yes. Okay, so you're my chief financial officer. You're still not convinced. There's something there. I can see that you're not comfortable with that. I don't know. But how much shall I pay you?
I'm just thinking, if Jonathan has a lot of risks, right?
He has, not a lot of risk. He has some risk. I mean, if he does insider trading or something like that, he goes to jail, yes. But if he doesn't do it, then he doesn't. So that's why he's gone through training and this and that. And I mean, he can break securities law, and then he's going to be in trouble with regulators here and there, right?
If I say the same as
For you?
yes.
I mean, look, you can do money laundering. Okay, you can, talk to some Russian friends and get some money, which was, blacklisted and gets into the fund, and you get us all in trouble. But that's about it, right? You have no risk. If you follow very simple rules, you have no risk. I mean, she can be disbarred if she does something bad with the contracts, or she takes money on the side from the ski resort or something. So, I mean, there's always illegal activity that you can do. But his risk is a bit more serious. He can make mistakes that he's not aware of, and then he's going to be in trouble with the regulators, and his name is going to be blacklisted forever. But in your case, I mean, you can do illegal things, but if you don't, you're pretty safe. But I don't know why this is. I don't think about the risks. I feel very uncomfortable thinking about those risks. How much shall I pay you? Come on, tell me. Give me a number.
Okay, then it's basically here 2 million flat, and let's say
CFO, I only pay you flat.
only flat.
Only flat. No upside.
Okay, then let's double it. 4 million.
4 million, that's too much. I'll give you $1 million, that's all. The CFO is very important, but there's typically a lot of people who can be CFOs.
Okay.
There's a big market for that. So if you're not happy with that, I'll get someone else. Maybe Laura wants to be the CFO. And then you have a bidding war between the two of you, I don't know.
I mean, then I don't have a choice, I have to accept.
No, you can say, no, I go back and I'm just going to listen to music and I'm not going to. But I need a CFO, okay? So let's say that. What else do I need? Normally, I'm going to need someone who is the chief risk officer. I need a risk officer. Okay, I mean, this is a very simple fund, but I need a risk officer. Someone who is, typically the risk officer not only does the risk calculations and the reporting to the investors about what the risks are, is someone who also it's the chief compliance officer. Someone who checks that we are running this fund according to the compliance rules of the jurisdiction we're in. That's a very important role. You'll feel better with a chief risk officer that takes care of the compliance. If not, you will be that, and then I'll pay you more.
That would be nice.
That'll be nice. Well, it depends. I mean, anybody wants to be my chief risk officer here? I have some people who have not volunteered. If you want to be the chief risk officer, you're hired. If not, I will upgrade your position and I'll make you the chief risk officer. No? No interest.
I think I'm not qualified for the position.
Sorry?
I think I'm not qualified for the position.
What do you mean? Why?
I'm more of a risk taker than a risk manager.
It's still, that's a job, you know. It still does a job. So
Do I get my salary right?
it looks like that. It looks like Laura is not interested in working, and Ludwig is also not interested in working. So
I think I will do a very poor job and you will fire me anyway, so
no. So maybe Ludwig can be my investor.
I think I could do that, yes.
Yeah, you can be my investor.
Yeah, sure.
That will be fine with you. So you can be my investor. And Laura, no interest. Huh?
There's the amount of money that I would make or force myself to read like really next week.
Sorry, I don't, say that again?
I think we can find an amount
Yes.
of money that would bring my joy to read.
Okay, so you're going to be tough. Okay, you want to make a lot of money. You're going to be tough. Yeah? Yeah, I don't know. Okay, so I think we have an understanding of how this company would be set up, how a fund is set up, where our investors are coming from, and how we get into business. And this is very important because in not understanding that is really operating on a vacuum. And then you don't know where money is coming and where money is going, and then it's hard for you to participate in the gains of that. It'll be very difficult for you to negotiate a salary if you don't know these things, right? Especially if you're going to make a career choice for the future. Like, it's unlikely that your first job is going to be the chief financial officer or the chief investment officer. But if you have an idea of where you would like to end up, then you know where to start. Some of my former students, they've decided to become lawyers because they were on the risk side and said, being a lawyer will help me, and then that's what they do, right? Many of my students have become chief investment officers, and that's what they wanted to, and they knew what they do. So you need to know what the path is. Your future is a blank piece of paper for now, but it should not be a blank piece of paper for a long time, right? If you overthink all the risks that you take, you'll be a blank piece of paper for a long time. Sometimes you just have to say something, write it there, and then make your choice. And my hope is that by the end of this course, you understand the investment process, you understand the investment roles, you understand everything. And then you can make a wise decision as to whether at each fork in your road you go to the right or to the left, because that is the decisions you will be confronted with. And hopefully you can make a choice. You will not have the choice imposed on you, in which case you will end up in a random place as a function of the circumstances, and I can almost guarantee that that place will not be particularly good. If you're a risk taker and you take decisions and you make decisions, then that will pay off for you better long term. That's why I'm doing this. And frankly, that's why this course exists from my perspective. I cannot say this to the university. This is not what a course description is supposed to look like. But I've been doing this for a long time, and I know that I can help with the future path of your career, and that's what I'm doing. Okay? Great. Okay, so let me now give you some more details about this, which I think is important. And then, I don't know, maybe we take a break, or there's a few more things that I wanted to say, so I will. A fund has a very important document attached to it. It's called the offering memorandum, or sometimes prospectus, or sometimes it has different names. But this is a fund. This document is the one that links the fund with the investors. So that will be, Luftig, if you give us your money, then you say, why am I giving you the money? It cannot be just an answer I give you on the telephone. There has to be a legal document that specifies what we are doing with your money. That's a document which is done by you. And that will be a document that you will read and acknowledge that you're okay with that before you invest. And it's a long document. It could be 50 pages, 100 pages, very, very long. And it costs a lot of money to do. Okay. In fact, it's something, typically you don't do that. You hire another lawyer to do that for you. Because if you're doing this in a particular jurisdiction, Cayman or something, you're not an expert on that. So you go and you hire an expert. But let's say that you do that. That is in your portfolio. You're responsible for that. And for example, this document will say, when you give us the money, Luftig gives us the money, then what do we do with the money? I said I was going to do snow swaps and this and that, and that's how I convinced the investor. Actually, that's how Jan convinced Luftig to give us the money, right? But then Luftig can say, how do I know you're not going to take this money and nothing illegal, you're okay, no, don't worry about this, we're not going to take this money and go and buy cars or things like that, okay? But maybe we buy stocks or bonds or something, which this is not what he expected, right? So this offering memorandum will say, we'll have a chapter on portfolio guidelines, portfolio and investment guidelines, and it's going to say, in this case, we're going to buy snow swaps. That's what we're going to do, right? And that's all we can do. And then my chief investment officer has to be in compliance with this document. That is done by you, so I mean, that's how we check on each other that we do the right thing. The fees, this document talks about the fees. So how does the fees work? We have to invoice the fund every month or every quarter or every year, right? Who writes the invoice? Who calculates the invoice and who writes the invoice? Sophia, you do that. That's your job, right? It'll have a chapter on valuation principles and methodologies. We have to figure out how to value this fund. Who values this fund on a monthly basis? We have to, Jan wants to send a letter to the investors, right? He said, oh, you made money, congratulations. Or you lost money, don't worry about it, right? Right? There's two letters. Who does the valuation? Sophia does the valuation. I mentioned earlier, there is an administrator. There is a third company, a third-party company we will hire to do the valuation, say KPMG. KPMG has armies of people whose job is to value things like that. And then you're the one who receives those valuations, and you come up with the valuation of the fund. You may agree or disagree. In this case, you deal with them because they work for the fund. You hire them. But then you are the one who says these are the valuations. And then you create your financials. And those financials go to Jan, because then Jan sends them to Ludwig and said, congratulations, you made money. Or, sorry, you lost money, don't worry about it. Right? But also, you're going to take those valuations, and those valuations will translate into the fees. So you have to send an invoice to the fund for payment that goes to the bank account of our company. And you do that. You're a busy person. You do this, and you have to do this like typically every day. Good. But how do you do that? How do you value a snow swap? We have snow swaps with a city and a ski resort. How do we value those snow swaps? Have you taken a course on pricing theory or something like that at FIM? You've taken a course in pricing, yes?
A little bit like that. A little bit of that series, yes.
Yes, you've taken a course on pricing theory, yes? You know how to price a bond?
Yeah.
You know how to price a stock?
Yeah.
You know how to price a derivative?
Yeah.
Good. So you've taken a course in pricing theory. I'm sure in that course there was no chapter on pricing snow swaps. I'm sure. Okay, so how do we price a snow swap? We need that, right, Sophia? Because this has to be, this is Ludwig's money. We need to say something to Ludwig. He invested in August. It's now February. Jan has to tell him something. What happened to your money? And we're in February. So you need to write now, it's February 2nd, you need to write it's February 1st, February 2nd? What is this? 2nd. You need to write the investor letter for January. And you need information from Sophia. What happened in January? Did we make money? Great. Yes? Good. How do you value the snow swap? Of course, you're going to ask KPMG. How's KPMG doing the valuation of the snow swap? You understand what I'm saying? We have $2 billion of snow swaps out there. 200 snow swaps. Maybe Ludwig is my only investor. It's $2 billion of his money out there. We need to tell him something. So we need to value those securities. If they were stocks, it will be very easy. You look at them on Bloomberg. If they were bonds, it will be easy. You look them up on Bloomberg. But snow swaps, I can guarantee you they're not on Bloomberg. Bloomberg does not even know that you signed a deal with the city and the ski resort. How do we do that?
But we need to write the investor like how we performed during January.
We need to actually give the investor a precise number at the end of every month. If it's a mutual fund, it's at the end of every day. Something like this, at the end of every month, we have to tell the investor the exact value of his investment. That's your job.
And also predict?
No, predict. No. In fact, we stay away from, we cannot predict. We don't predict. No one says the word predict. We're not allowed to do that. We do not predict. Prediction studies in a weird website. We don't do that here. No. called the broker. For what?
For the current market price.
But it's a snow swap. Who's the broker for the snow swap? There's no brokers for snow swap. In fact, the only thing closer to the broker is you and him. You're the ones who are brokering the deals, right? So what would be the price for a snow swap? I'm appealing to your knowledge of pricing theory, financial securities, and this and that to answer this question. Jan.
Trying to think of a way how to maybe replicate the cash flows of
Okay.
no swap. I don't know if that's what you were looking for.
Well, I'm not looking for anything. Okay, I want you to be aware of a very important process in financial markets, which is the process of valuation. I'm not going to answer this question. This is something very important, very, very important that I want you to understand. For that, I'll give you one example. Once upon a time, I had one of my students who went to do an internship. And her internship was to do what's called P&L reconciliation, profit and loss reconciliation. And that's something that you do every day. And it was for a pension plan. And then she told me that it was a very boring job because what she had to do was P&L reconciliation. And I explained to her that no fund can survive without a daily P&L reconciliation. So it may look very boring, but it's critical. You can't have it. You need to have it every day. You need to have it. If you're in the business of managing money, you need to know how much money you have every day, right? If you're flying an airplane, you need to know how much gasoline is on the tank. If you're running out of gasoline, is not a good idea for an airplane, right? So, similar. So this is a very important function, and you do that. But now, usually that looks like easy. You have stocks and bonds, and you get the price. But in this case, with snow swaps, how do we do that? How do we price? By the way, the reason I'm asking that is because we're going to have a chapter in the offering memorandum that talks about how to value our securities, and our securities are swaps. So you have to be able to value these swaps depending on the regularity required by our fund. This would typically be a fund that requires monthly reports. So every month we need to do evaluation. How do we do that? And you've taken courses in pricing theory, so what have you learned in pricing theory that we can use for this?
Build a model.
Okay, build a model. You've seen, you build models, right, for pricing, in pricing theory, right? Yes? And the model, what did it take into account? Let's go back to your course on pricing theory, and let's try to extract information from your course on pricing theory that would apply here. Okay, so you have interest rates, yes? Interest rates should be a factor in the pricing of the swaps.
We have the volatility.
The volatility, oh, the volatility was a function of pricing? Well, it was a function of pricing in derivatives, right? Yes? Yes. For derivatives, you use the volatility because it's in the Black-Scholes theory. When you price swaps, have you used the volatility to price swaps? No, swaps don't.
But then you just discount our future cash flows, right?
Yes, you have to discount future cash flows. But in this case, when you discount future cash flows, they are of two types. Deterministic cash flows, bonds. Stochastic cash flows, stocks. Which ones did you use for pricing? Deterministic, always, for sure. But do you price stocks looking into the stochastic cash flows of the future? No. No. And the only reason you would use cash flows in the future for options is when you use the risk neutral measure, because that gives you a way to discount them to today. But as you must have been told, that's very lucky that you have the risk neutral measure for options. Sometimes you don't. And you probably know that in incomplete markets, there is no risk neutral measure.
Can we use that net gross portfolio as a numerator to discount that?
No. If you're only in complete markets, in incomplete markets you can, because you can't hedge.
But then we will have a price range, right?
You may have a price range, but she's not allowed to report the price range. You cannot tell Ludwig, your price is between 1 and 2 billion. I'm not sure which one I can do that. It has to be a number, right? Which is dictated by the administrator and will be approved by the auditor. Our investor is leaving. He's not interested.
I will wait until you set up the fund and
Okay.
then we talk.
All right. All right.
Then we need to calculate the discount factor at the present value of at this point.
The present value of?
What's the name of that again? Present value of this point, something like that, I think.
I don't know what you're talking about.
When we do the discount.
But let me give you the answer. The swaps will be priced at 0. We can't have any other method. I know this could be surprising, and this is one of the things that's why I like this example so much, because look, I teach pricing theory in my course too, but I always say that pricing of securities is something that very few securities accept. Most of the investments that you do don't give rise to pricing like the ones that is taught in pricing models. That's why pricing models are so wonderful, because it's very rare you can price securities. Very rare. Most securities can. If I invest $2 billion in the build-up of an airport, because it's my airport and we're not get cash flows from operating the airport, how do I value my investment? You can't. Many investments you cannot value. You can have an expectation of the performance, which is what we did earlier, but that is not valuation. Valuation is different. It's what we report to the investors. And in this case, you also may have heard about the General Accepted Accounting Principles, GAAP, right? Have you heard of that? Generally accepted. It's the way that, so as a chief financial officer, your reporting has to be GAAP compliant. And there are certain methods to do accounting which accountants follow. You have to follow them too. So for example, we cannot take into account whether there's a lot of snow on the ground or not to value our snow swaps. They're not in the GAAP principles. So for that, there's only one way, which is to value them at 0. And at the end of the year, when we get payment, then you value the cash which you have received, but only when you receive it as part of the fund. Right?
Can we report our investor that the value of the swap is 0?
Yes. The swap is 0, yes. That's what you will report to the investor. So the fund is going to have an accounting statement which is very simple. Cash, $2 billion. Everything else, 0. And then at the end of the year, you're going to get maybe 200 million as stated on my spreadsheet. And then in a year you have, new fund financials, cash, 2.2 billion. Or if you want 2 billion in cash, and then a swap that finally has a valuation which is not 0 and is 200 million. That's how you do it. And that's what you do, right? But sometimes you're dealing with securities which are somewhere in between. So in this chapter, for our fund, it will say swaps are valued at 0. And he already knows, the investor already knows if they're valued at 0. He signed this OM, so that's what he expects, because we told him. But imagine we have some sort of a mortgage IO. Do you know what a mortgage IO is? A mortgage, I'll give you an instrument which is on the borderline between you can price, you cannot price, right? So a mortgage IO is Banks give mortgages. And then when bank issue mortgages, what they do is they sell the mortgages typically to a hedge fund because they don't want to deal with the risk. The hedge funds deal with the risk and they just sell them, right? And when they sell them, they can sell them into two, they splice them up and they sell them into mortgage POs, mortgage IOs. Mortgage IO is interest only. Mortgage PO is principal only. One deals with the risk of interest rates, the other deals with the risk of the collateral. And they sell them and they forget about those risks. And these are securities which are constructed. If you look at the mortgage IO could have a valuation methodology which is non-trivial because interest rates go down, mortgages have built-in options that you know how to price and they have prices. Therefore, there could be a very complicated methodology to report something which is not zero in the mortgage IOs. And then you're going to have pages and pages of formulas. But let me give you a warning. Those formulas have to be formulas that a judge understands. You cannot give an integral between this and that that cannot be used in evaluation principle. The formulas which will go here, because this can be challenged in court, they have to be formulas that a judge will be able to interpret. This is very important because a lot of the math we teach in finance courses is math which may be useful for decision making. So Jonathan will use that to make decisions of his investments, but typically those will not be used by you because they can be challenged and you need to be able to defend them. So if he has something which is, it can have sums, it can have subtractions, it can have multiplications and divisions. But something which is more than that, difficult. And you will rarely see evaluation methodology which includes something different from that. Welcome to the real world. That's how the real world works. Okay? It will talk about liquidity provisions. So what would the liquidity provisions be for a fund like this? Liquidity provisions is Ludwig, when he invests in the fund, if he wants his money back meaning if he wants to take some of the money out of the fund, when can he do that? Can you just call Jan and say, Jan, give me, of the $2 billion I gave you, I need one, quickly. Because my Bitcoin account is doing very poorly and I need some money or something. And then Jan will tell him, you have to wait until when? There has to be a liquidity provision that says the investors can get their money when. When do you think for a fund like this, the investors can get their money? Every year, yes, exactly, every year. And not only that, we'll probably tell them, and you have to give me 6 months advance warning. Even before that. So if you want your money in 2027, is like you have to tell me now, because if you want your money in August of 2027, it may already be too late. Right? Why? If he wants his money back, then he'll probably tell you, and then what do? You tell Jonathan, and then Jonathan says, oh my God, I need to break up 2 contracts. So Jonathan calls my lawyer, and you need to do something. And that could actually cost the fund a lot of money.
What is the maturity of all swaps?
Okay, so I didn't mention that, but let's say they are 1 year. So that means that my swaps, let's say they will be up for renewal in August. But typically I don't swap the day before to negotiate the renewal. I'll need some time. And that's why I would say I need 6 months before you can take the money out. Right? Maybe like now, maybe even too late to renegotiate my fees or to even not renew some of the, I may already have committed to my investors to my counterparties, skis and cities, that I'm renewing my swaps for next year. And so see, that liquidity affects the work of my lawyer and my chief investment officer. Because these things are not fast, they're slow. So you need to know how much time you have.
Yeah, I was just thinking if you make the maturity of the swap, for example, half a year.
Yes, but that the city and the ski resort will not accept.
Okay.
Right? Why would you? It will be very good for us, for sure. And Yuan-Chin, when she goes and negotiates, she will probably try to get the best liquidity possible. But the city and ski resort will look, if you insist in less than a year, please just go away, because there's no way I can deal with that. Right? So we have to be realistic about that, and everything has to match. So our liquidity provisions has to manage our counterparty obligations, we have to report to the investors, and the investor taking money in and out has to be consistent with this. Are you getting a good sense of this? Is this looking real? I want this to look very real. I picked a very simple example so that everything becomes very real and very weird. And you may think this is not weird, by the way. If you look at it, say, for example, the typical infrastructure investment project, I don't know who built this building or this whole campus. I don't think it was TUM, definitely no, it was some private company. I'm sure a lot of the issues they went through when they built this business campus are very similar to the ones we're dealing with here. Because the investors invest, and they invest in these buildings, and how are you going to report to the investors about the value of the building when it's still halfway through? You're going to have to follow considerations very similar to the ones I'm talking about here. You understand? That's why I'm doing this. To talk about bonds and stocks is very easy. Those are the most efficient markets that exist, and I don't want you to walk away from my course thinking that everything is easy like stocks and derivatives and options. No. I'm going to spend a lot of time talking about those. Don't worry about that. I know that's what you like, and a lot of your jobs may be in that area, but they're like that. And who was doing M&A here? Was that Ole? No, that was you, Ludwig, right? When you do M&A, forget it. I mean, like, this is too much information. You typically don't even have that much information. I don't know the kind of companies you were involved in, but when you have a company whose main assets are in telephones and wires and warehouses, and the valuation of that is very hard too. So this is normal, a situation where you really don't know and you have to make a guess. And one thing is to make a guess putting your finger in the wind, and then making an investment decision, which is what Jonathan is doing. And a very different one is the one that you do, that you have to report a number to the investor, which is not up to the imagination. It has to be backed by facts and by very strict principles. You understand? So all the math finance you have learned so far, everything fits within this framework in our own portfolio. You see, the act of investment in a commercial way, we are dealing with the assets which are in our portfolio, and we're dealing with the investors to whom we have obligations, and those always have to be aligned. And that is some of the most difficult parts of the investment process. Typically, when someone talks about investment as an activity, you think about what I invest in, and that's very important. But I want you to realize that that's only a small part of the story. If you go to one of these big investment houses, Allianz Global Investors, Munich Re, you will see that the people who make investment decisions is a small part of the organization. And you will probably, if you get into the investment sector, you will see that some of you will be in the decision-making part of the investment management, but most of you will be in some of the peripheral areas. And already when we discussed who does what here, in everything we did, there was only one person that was taking care of the investments. That was Jonathan. Everybody else was taking care of other things. You were taking care of make sure we're not in trouble. You were making sure that the numbers matched. You were making sure that everybody did what they had to do. You were making sure that our revenues kept coming. Because investing without revenues, and by revenues I mean being paid for that, it's not a business, it's not an activity. No one will do it just for fun. So everybody had a role to play, but only one person was in charge of making investment decisions. So, and that's why in my course, which aims to be very realistic, we're going to be dealing with a lot of those intangibles, a lot of those things which are typically not spoken about, especially in the world of mathematics. But I will do that. So this is basically what we discussed. If we have the wrong liquidity conditions, we may enter into trouble. You may have to break up some of the contracts that we have in place. This could be tremendously bad for the investors, for the fund, for us. Everything will be. So it is important to do. So this is another part of the risk management. Liquidity risk is a very important part of risk management, which we need to do. And sometimes this is very hard to quantify. In fact, you may not even want to quantify it, because a lot of these things can be predicted. You just make sure that everything is aligned. So in this organization, who will be in charge of all of the things that we have here? Who will be in charge of this? Will Jonathan be in charge of this? No, Jonathan is going to be a supplier of key information. He's the one who knows the liquidity of our portfolio. So we can ask Jonathan, can we liquidate $100 million in a week? And say, you're crazy, I can't do it. I need a year and a half. He has that information, right? But there's a lot of other things here that we need to report. That is very important for you, because you have to organize all the operations, and liquidation is part of that. You're the one who's going to get from the investor who left, whether he wants his money back, when, what. So you're the one who has to make that happen, right? You're the one who has the interface with the investor, and then you talk to him, because you are the one who has to coordinate with everything. You have to get the money in or the money out. You're the one who has to write everything down so it all works, right? You're the one who said, guys, someone didn't think about this possibility, and if that works, we're all in trouble. That's a source of risk. Back to your question of this morning, how we measure. There's a lot of risks, a lot. Some we can quantify and some we cannot quantify. And liquidity risk in this particular situation is something that should be managed. Everybody should understand all of the pieces of the investment process, all of the little fine print in the contracts and everything that could happen, and then have a process, internal process, that gives rise to no problems. Many of the risks that funds have experienced are related to this. Margin calls is an example of liquidity risk, and they are deadly. Sometimes the funds recover crippled, sometimes they die. So that's another risk. But this one is something that we could sometimes, say the Jonathans, the chief investment officers, they have a certain idea about the liquidity, but sometimes that's just not the case. Here we know that we have no liquidity. But if this was a stock portfolio, we may be led to believe that we have liquidity. And then liquidity suddenly disappears from the markets. And what do? So Jonathan, you told us last year that you could liquidate $100 million in a week. So guess what? That was last year. I can't do it now. We have a problem. That's a risk maybe we didn't account for. Is there a mathematical measure that says the integral of something is this? No. Is that something that we need to do on a case-by-case basis? Probably. Right? So Jonathan may decide to hire someone working for him that monitors these things. And this is the professions which are typically called the quants, that some of you may have done. You work under the investment head, taking care of different aspects of the risk of the portfolio. In this case, it's liquidity. Okay? All right. So since I just want to give you an overview, I want to move away from this. And then I want to talk about the second part of the investment life cycle. We saw how the fund was conceived. That was with my idea. In that meeting, I said, oh, I think I can create a very efficient portfolio with $2 billion. That was the conception. And then we went to the birth. The birth was when I hired Yun Chin. Did I say correctly? Oh, you have to show me how to do it in Pinyin later, and then I'll, okay. And that's when the fund was born, when we had the legal agreement, the offer memorandum done. Okay, then it's signed. That was even before Ludwig invests in it. At that point, it's already born. That's the birth. And we've gone through the organs, how it relates to the investment process. We went through that. Now, let me tell you how it grows. It grows, now we are, we go to work every day. I don't know what time we show up for work. What time do we show up for work? 8:30, okay, 8:30. Since we're doing snow swaps, it's not very important. If we were doing stocks, what time do we show up for work? What time does the market open? I think it's 9. I think it's 9. Germany is 9. So what time do we show up for work? I love this question. Okay? What time do people go to work in Germany? In the financial sector, if you're working on the Frankfurt Stock Exchange. So if you're trading on the Frankfurt Stock Exchange, what time do people go to work? Do you know? 8? Are you guessing or do you know?
I'm guessing.
You're guessing. Okay, so let me tell you something before I ask. This is an important question. There is a measure that I use to determine when people go to work. It works very well in the United States. I don't know in Germany. In Canada, so-so. Which is, at which time do Starbucks open? You go to New York, you go to Wall Street, and Starbucks open, the market there opens at 9:30. The Starbucks open at, make a guess. 6:30. So Starbucks tend to open 3 hours before market open, which is at about the time that the first people show up for work. So according to that, in Germany, we should go to work at 6 in the morning. Right? Why? Because when you go to work, if the market opens at 9, you got to be ready by 9. It's not that you start working at 8:30 and then by 8:55 you say, oh, let me see what happened in Asia today. You need time for that, right? You have been typically out of contact with the market, so you need to know. So can you do me a favor? Can you find out, I don't know if this works in Germany, can you find out at what time Starbucks open in the financial district in Frankfurt?
Found one with opening hours starting from 7 a.m.
7 a.m. So that would be my guess. Again, I don't know if Starbucks is a good measure. You may have a different chain used by the financial employees. I don't know. I'm sure that the local bakery is better than Starbucks, but I can't check what time they open. But that's a very good measure. Do you know in San Francisco at what time Starbucks open in the financial district? Make a guess. San Francisco. She's gonna check it out online. That's okay, you can do that too. What's your guess?
Including the time difference to New York, right?
When you show up there, Starbucks, there's a little sign that says open at, close at. So they open at, what does it say?
4 a.m.
3:30. I'm sure there's one at 4, yes. That's one for people who arrive late. Yes, people go to work at 3:30 in the morning.
Because of New York?
Yes, if they're trading, the San Francisco stock market is So they trade in the New York, so they have to show up at 3:30. Unless they trade the Asian markets, in which case they actually probably go home like at noon, so they work through the night. But if they work on the North American markets, they go to work at 3:30. Same time. Not time zone time, but same moment as the people in New York, because they are competing with them. They can't be late. Yes? Okay, so this is how we work. So we go to work, and when we go to work, what do? Well, you take care of the contracts, you take care of that the numbers are correct. Jonathan makes the investment decisions. How does growth happen? Growth happens because of you. We can only grow if you bring us more people like Ludwig. That's the only way we can grow. Right? But now, in the growth, assets under management is the main measure of the business that we are doing. How many assets are we managing? We have $2 billion. Great. Those $2 million, they make us money. We saw that, 56 million. Of that, how much did I spend on salaries? About 10 million. So I got 46. What would I do with that? It's all for me. It's my company. That's great. I make $46 million. Or maybe not. Maybe what I do is I say, well, I'll take some of that as my compensation, which I'll do as profits, not as salary, because it's more tax efficient. And the rest, maybe I reinvest to create other businesses. There's different ways to grow. So for our fund, the limit to our growth is the capacity. If I was dealing with stocks in the New York Stock Exchange, if I'm dealing with futures in the Chicago Board of Trade, then the limit is the sky. I could be huge and it's no problem, right? But for many other investment funds, there's a limit to how big I can get. Let me consider our snow fund. How big can we be? We already went through that. I have $2 billion. That's it. I went through every city, every ski resort. I cannot create new ski resorts in Canada. I cannot create new cities. So my fund can be $2 billion, no more. The cities don't need increased protection. The ski resorts do not need increased protection. The business is what it is. It's not going to grow, so I don't grow. With $2 billion, I have a nice product that I sell. There's no way I can make more than $56 million. I cannot become $1 trillion company. So I have a lot of money that I can invest, but I can't grow as a business. That means I cannot hire more people like you. I cannot hire more people like you. We're happy. We're making good money. Except him, but okay, but that's okay. I'll be nice. I'll give you a nice bonus. I'll give you a nice Christmas card, you know. But how can this, I mean, we just checked earlier, BlackRock is $11 trillion of assets. So how did they get there? How do you grow? All right, so for funds, if you're in the investment business, capacity is an issue. If instead of being in the snow fund business, we build airports, that's our business, how many airports can we build? That's our limit. It's called capacity. There's only certain things that we can. If we're in stocks and bonds, we're unlimited. And that's one of the reasons that many courses on investments deals with that, because they have unlimited volume. But the reality is that even there, you have an issue. Even there, you have an issue because not everybody trades. Even if you look at, say, BlackRock, $11 trillion of AUM, you will see that a lot of that 11 trillion is broken up into hundreds of different investment funds like this. And each of them has its own natural capacity. They are so big because they have many funds, not because their funds are necessarily very big. The ones that deal with stocks and bonds and futures, which are huge markets, are big. But they also have funds which are not. They have funds in private equity, and these things are limited. So I want you to understand the concept of capacity and how bad business decisions can be made that lead ultimately to death, which is my next chapter in this introduction of this morning. These were our financials, right? Sophia, these are your numbers. This is what you aim for, and then you make us all very happy. You are the lifeblood of this company. You are the one who says, oh, here's your $2 million check. Here's, don't worry, I have money for everybody, right? To pay your salaries. And you send me a very nice shareholder report at the end of the year saying that my company is making $40 million profit and I'm happy per year. Now, imagine this. Jan here is very unhappy because he's not making a lot of money. But then he says, I have an idea. I think I can convince Ludwig to give us another $2 billion.
I'm sure I can do that.
I'm sure you could do that. Okay, and then, but of course, how much you want for that? You're not gonna stay with your €500,000 per year, right?
I mean, I need at least double the amount for.
Oh, you're so cheap. You're so cheap. You offer me $20 billion and you only want to charge me €500,000. Okay, that's good. That's good. Okay, but so let me walk you through what would happen if I have €4 billion, right? You probably, let's go through this calculation. I only have, I go to Jonathan, I said, Jonathan, I have $4 billion now. I said, oh, that's great. I can't get a single more snow swap. So the snow swaps will continue to give me $200 million profit. There's nothing else I can do. But then you tell me, I say, wait, but now we can make $40 million of management fees because we're managing $4 billion, right? And we charge 1%, right? Yes? Great. So the performance fee is going to be a little bit less because now our net gain is not 180 like before, it's 160. 20% of that is $32 million. So my company is going to make net $72 million. That looks great. No? Except my investor is going to make 3%. Okay, what will happen?
The price you pay for Jan is now qualified because the investor is unhappy.
The investor is probably going to be unhappy. Correct. Correct. Forgot your name. Leon, that's right. By the way, when you change seats, I'll forget your names again. Okay, or I'll call you a different name. Who knows? Leon. So, what's the thing to do? What's the smart thing to do?
I would invite them to a dinner and they will be happy again.
Okay. And all of that for €500,000. You're good.
No, he's too expensive.
I think they will not be happy. Doesn't matter. I don't know what you're planning to give him for dinner, but I don't think that will make them happy. This will probably be the end of the firm. So because of that, I am the CEO and I'm not prepared to, if I was prepared to retire, I said, well, that's a very nice retirement bonus. The firm ends there, but I don't care. I made $10 million extra and then I don't care. But if I do care about the longevity of my firm, I'll say, no way, I'll stick with my business. It's a good business, very happy, and I have $56 million for a lifetime, as long as I can continue to bring this product, right? Or I could consider other things. I could consider the possibility of doing other snow swaps in other places. For example, do you think we can do snow swaps in Russia?
We can try.
We can try. Now, we'll have to check if our portfolio guidelines allows that. Very likely, if our portfolio guidelines are done correctly and our investor is happy, the first thing that my investor would ask is, where's the geographical location of these snow swaps and can I trust the legal system there? And for that, we'd probably say, we're going to stick to, this and this and these countries. So we're not going to do snow swaps in Russia, for example, where it's not sure that I'll be paid, let's say, right? So if our portfolio guidelines allows, we could extend that. If they don't, then we don't, right? So this is how we can consider possible ways to grow. But you can see here, growth could easily lead to death if we do it the wrong way. So there's different ways to die. Funds are happy until they die. One way in which they can possibly die is fraud. And I'll give you one example of fraud, which is very important for us today, because it has to do with something I talked about earlier. Performance drag. For example, we grow our fund beyond the natural capacity, and then this is not restricted to snow swaps. It could happen that, for example, in the business of mortgage IOs that I mentioned earlier, some funds, that's what they do. They manage the risk for banks for mortgage IOs. But there's a limited supply of those, which is a certain bank has a certain number of mortgages, and that's what you do. And then if you accept more money for the investors, that does not mean that now you have more mortgage IOs. So the same effect that we saw here is going to happen. Your assets, your performance will suffer. It's always the case. Doesn't matter what you do. Even if you do stocks and bonds, sometimes your activity is limited to a certain area. I do technology stocks of technology companies valued under $2 billion, because that's my specialty. That's where I can get the really good investments. Oh, sorry, in this case, Jonathan, right? My chief investment officer. Well, there's a limit to that too. Everything has a limit. So if I go beyond those limits, I could enter into that or blow up. Blow up, for example, have you heard of the fund long-term capital management? You've heard of that. The rest, you've heard of that. You have not. The others have not heard. Have you heard of Myron Scholes from the Black-Scholes theory? Have you heard of that? That's Myron Scholes, a Canadian Nobel Prize winner. Robert Merton. Well, they were directors of a fund that blew up in 1998. We'll go through how they blew up and why in a few days. It's going to be one of the examples that I will use. But this could happen. We could blow up, okay? Or we just, people just don't want to invest in our fund. Great performance, whatever, but they don't want to invest. And at some point say, you know what? I have something better to do with my money. So I close the business, I close the fund, I fire all of you, and then I move on. Okay, that could happen too. Now, this is the case of fraud, which I want to mention. It's a very interesting case of fraud. Has to do with Bernie Madoff or Madoff, depends on your accent. He lost $65 billion to fraud. His case was fantastic. It was very, very interesting. So this guy was very famous. He did something very remarkable. He created the NASDAQ exchange. He was one of the creators of the NASDAQ exchange. So he knows about finance. He's one of the world experts in finance. He died. He was one of the world experts in finance. And he knew so much that he also knew how to take advantage of the system. I will summarize what he did as follows. Remember that picture that we had where I show you the fund, the architecture of a fund, investors on top, fund in the middle, asset management company, and service providers underneath. Remember that? And I mentioned that in the service providers, we have the management company, we have the broker, and we have the administrator. What did they do? The management company makes decisions and gets paid by the fund. The decisions typically involve a trade, which is done through the broker. The broker is the bank, not the bank that holds the cash, but the bank that does the trades. And then those trades are valued by the administrator that counts the money and said, oh, this is worth this much money. Understand? Okay, what if all those three, and I said they should be independent, and we talk about Deutsche Bank and this, remember? Okay, what if those three are the same? What if the administrator, the broker, and the management company are the same? I'm asking you now to come up with an idea which would be illegal and unethical That's what I'm asking you. You have to be, because you have to be in the defense. And in the defense, you need to understand what the thieves are going to do to you. So what would you do?
I know this case to some extent. I think what he did, he faked trades. So as a broker, he write down trades that he allegedly did.
Exactly.
He also valued them as the administrator then, and cashed in management fee and
a performance fee. And the performance fee is even easier, right?
Yeah.
Yes, and it's bigger.
Just showed his investors fake returns, and because his returns were so great, not many people wanted to get back their money. So it was basically a Ponzi scheme.
Exactly. So if I can use, the same, almost the same team as I created earlier, I'm going to create now a team for an illegal operation. And I'm not doing this because I encourage you to learn about illegal operations. That's how you learn what's illegal, unethical, and not only you should not do it, but also when you're dealing with someone, you cannot assume that they're ethical. You cannot assume that they are legal. You have to be, as I told you, street smart and figure out ways in which people can steal your money, because that happens. So in this case, let's act. Let's say that I'm Bernie Madoff. I'm the crook, but I'm a smart crook. I know everything. So what I do, I'm the broker, as you said. My investor, we convince them that we're great. Look, these are my returns. This is how much money I make, 10% per year. It's fantastic. Rain or shine, I make the same. And where are these numbers coming from? Well, they don't know, but we know. Because what happens is, as you said, I fabricate trades. So I get one of you, or even myself, someone I trust. Because if I'm going to do something illegal, I need to work with someone I trust. I fabricate trades. I make trades that didn't happen. I make up a trade, I make up the numbers, I make up the sell price and the buy price. And I put them into a broker statement that looks correct. And it's correct because it's my statement. I'm the one that runs the brokerage. And then I send them to the administrator. You are the in-house administrator. Let's say that you're the out-house administrator. Same thing, right? In this case, actually, the administrator was outside of the firm, but this administrator had 2 employees and managed $65 billion. And they only had 1 client. So the only source of income was me. So it's just the same as saying that you only work for me, right? And you knew that. And you knew that you could not lose me as a client because you're making very good money for doing nothing. And one of the things that you have to do is I send you the broker statements. You don't ask. You said, oh, very smart, very good, wonderful. You're making 10% return. And you give me those statements, which then I use and told, oh, it's an independent administrator, right? You understand what I'm saying? And then I show that to all of my prospective clients, and then they keep on giving me money. Very few people want their money back. Most people want to be part of that wonderful investment scheme. And they give me the money. And the more money they give me, the more management fees we can charge. And of course, the more performance fees we could charge, because my performance was damn good. Right? You understand? That's what it was. And all of the story is there. What happened was, in 2008, as you know, everybody will need their money back. I don't care about your performance. I need the money. I don't have money. I need the money, and all my money is with you. So by 2010, the 65 billion had a lot of redemptions, which is people wanted their money back. And at that point, you had to say, sorry, I don't have it. And he didn't have it, and they couldn't find it. And, well, he was arrested. He went to jail, and he died in jail in unclear circumstances. $65 billion is a lot of money. Okay. That's one example, which, again, I'm not showing you to encourage you. I need you to know that this is the real world. In the real world, these things happen, and people like that are everywhere. Always ready to take your money. Okay. And at the source of the problem is something that it's a risk that we already established as a risk, which is we need to have service providers who are conflict-free. I mentioned Deutsche Bank. I'm not going to say Deutsche Bank is a Madoff. They do have the same characteristics of Madoff, but of course they have the oversight of BaFin, and so you assume that someone checked the trades, you assume that someone verified that they're not lying to the public, and you assume that the consumer protection agencies are doing their work. But the fact of the matter is that what he did is what Deutsche Bank does every day. What he did, meaning the modus operandi, okay, the operational activities and the conflict of interest is what all banks, not just Deutsche Bank, all banks have this all the time. Banks have a lot of oversight. This guy does not have a lot of oversight. But if you go to the course website, you will see a letter. It's in the documents. I didn't point them out to you, but in the course website, you have a letter written by someone by the name Markopoulos. It was a letter written to the Securities and Exchange Commission, which is the regulator, the United States regulator, is the BaFin of the United States, basically explaining in great detail to the Securities and Exchange Commission why his belief that this was a massive fraud case was very likely. Of course, he had no proof, but he presented a lot of very well-established thoughts why these numbers are impossible. Read the letter. It's a great letter, and you learn so much finance reading that letter. You've taken lots of courses in pricing, and I advise you to read the letter on the website on the Madoff case. That is a letter about the real life, about real investment activities. The Securities and Exchange Commission, of course, ignored it. They were more worried about other things, who knows? And in the case, the letter was exactly correct. All his suspicions were right. So the SEC only needed to just go and check, and I don't know what they would have been able to do because the money was probably gone already, but they didn't. And something about the regulators, and it somehow goes in connection with our discussion earlier, Jan, about the need for regulators to be more smart technology-wise. Right? Good. All right. Now, but this is a more interesting type of death that I want to mention, and is related to us. So we launched our Snow Fund, and we're all happy out there with our great business, making us $56 million a year. Well, that's to me, for you, a little bit less. And then I read in the newspaper this news. This is on the Canadian newspaper, it's the Globe and Mail. And I see an article that talks about Intrawest having a lot of debt and actually going bankrupt. Debt is in default and declared due, given the lack of progress on restructuring talks. So this is the news that I read on the newspaper. For most of you, this means nothing, but for my chief investment officer, he gets almost a heart attack. Because my chief investment officer knows that Intrawest is the company that owns all the ski resorts we're doing business with. What happens? What happens after this? They own every single ski resort we're doing business with.
They can't pay the swaps anymore.
They're not going to pay. They're not going to pay. Even if they could, they're not going to. They're not going to pay. The last obligation they will honor is a snow swap with a fund. They're not going to do it. They'd rather pay their, hotel towel provider than us, right? Because they cannot run out of towels. But us, they don't care. They're not going to pay. At which point, collectively all, we start to pray for what? What do we pray for? We pay for global warming, right?
But we don't need to pay for cities.
Sorry?
We don't need to pay the cities.
We don't need to pay the tickets. What tickets?
The cities. The city.
So that's right. So we want to pay to the ski resort. That's right. When you have a bankrupt counterparty, you want you to be the one to pay them. You don't want them to be the one to pay you, because that's not coming, right? You understand? But let's say that our prayers don't happen, and this is what happens. To have $2 billion invested, and we lose just a little bit of money. We lose 60 million. Because this is of not snow-related events. This is, they just don't pay. We still charge the $20 million to the fund. So my company is still making $2 million. So I still do okay. I still pay all your salaries, and I still do okay. I may have some money left for me. But of course, no performance fee. But the investors lose $80 million. And that means my investors lose 4%, and I make $20 million. That's okay, and no one goes to jail. We're all good. But the investor says, how quickly can I get my money back? Because I'm leaving. Can we explain about global warming and this and that? No, it's not going to work. There's nothing that will contain the investor. And you can take him for dinner, but that'll be the last dinner you have. It's no problem, right? That's another way to die. This is performance track. So from here, we'll learn a number of things. And this is what I call the risk taxonomy, and I'll finish with this. The risk taxonomy is the type of risks that we have. So there's some type of risk which go under market risk. This is loss of value because of change in asset prices. Markets go up, markets go down. I get a lot of snow in the cities, all those things. This is a market risk. Credit is someone doesn't pay. Like Intrawest goes bankrupt, my ski resorts don't pay. Liquidity risk. Long-term capital management. I'll explain to you what that is. Basically, you need to pay. You may have a lot of assets worth a lot of money, but you need to pay in 24 hours, and you can't turn your assets into cash. And most transactions, they require a cash transaction, not say, well, I own this building, I'll pay you in a year when I can sell it. Say, no, you have to pay me tomorrow. That's liquidity risk. Gap risk, I want to ignore. Legal risk. You're doing something that then suddenly declares that to be legal. We do our fund, and we make a mistake. We set up the fund in Germany. And then BaFin goes, analyzes our fund, and says, what are you doing? I'm doing this no swap. You're doing what? Didn't you know that this is illegal in Germany? This is gambling, and Germany does not allow gambling. He says, no, gambling is, I decide what's gambling. This is gambling, you can't do it. So close it, go to jail, whatever, That's legal risk. And operational risk, that's actually Barney Madoff. So we've seen examples of the risks that one faces. These are the risks which you cannot do without. Again, investing is taking risk into return. That's what it is. You just need to be smart about the risks that you take. If you're lucky, you can measure them. If you're unlucky, well, don't. Avoid them if you can. But the process of investing is always that. You take risks to make return. And in this course, we're going to try to understand the sources of risk. On occasions, we can measure them one way or another. In other cases, we won't, but we need to be aware of them. In risk management, there's 3 types of risks that you have. Or no, not risks. Well, yes. One is the risks you know, which is what people talk about. The risks you don't know. And we're going to spend some time with that, and that is your ambition as to how much. And the other is the risk that you don't know you don't know. And this is the one where the good investors beat the bad investors. It's not that they control the risks that everybody knows. There's very little differentiation there. The big differentiation is in the risks that they don't know, but you know. And that's what will make you better investors. And that's my objective with this course. Okay? So by Friday, you will have a very big catalog of risks. You will know which ones of those lead to performance and which ones you just take for free. Some of them we can measure. Some of them we cannot measure. But that will be my objective for this week. Is it clear? That's what we will do. So, okay, so I'm finished now with my introduction. Maybe some words about vocabulary. Speculation versus arbitrage. This is something which is oftentimes misunderstood. You cannot obtain returns without taking risks. And risks, there's two approaches to risks. One is you can hedge them, you can diversify them. We will learn about that too. When you have investment opportunities with lower than normal risks, it's oftentimes called arbitrage. The academic definition of arbitrage, which is making money for free, is very academic and it rarely exists. People usually do not call that arbitrage. Arbitrage is when you take a certain risk where the ratio of return to risk is very, very high. Okay? Not infinity, as in the definition, just very high. Market inefficiencies are a source of this type of arbitrage. When, oh, I know something. Not insider trading, that's illegal. Okay, I know something. And no one else seems to be aware of that. So I take the advantage of that. That will be arbitrage. And that's a market inefficiency. We'll see examples of that. We're going to see examples of everything. Okay, I started with this big example, but now I want to use that to give you the taxonomy. Hedge funds are my main objective for us to understand how investment works. And I know that in this country, you say hedge funds out there and you go to jail. Hedge funds here are misunderstood by everybody, by the regulators, by the investors, by the public. What can I do? I can give you one thing, which is by the end of this week, you will be not at the 1%, at the 0.01% top of people that will know about hedge funds. You will know a lot about hedge funds. Okay, don't tell anybody, because you will be declared dangerous person. But you will be dangerous because you'll be very powerful. You will learn what they are. Okay, and what is a hedge fund? A hedge fund is simply an investment activity which does not follow the established categories in the jurisdiction you're in. So there's no fund we have here, that's a hedge fund in Germany, because it does not follow into the classification plan that we have. Okay, so for most people, a hedge fund is a machine that goes and steals your money. Yeah, some of them do that, like Bernie Madoff. That was probably also a hedge fund. But you should know better. And very often I will call a hedge fund some activity which just does not fit into the boring world of mutual funds and index funds. And I call them boring because there's really not something of interest to us. If this was a course on sales and marketing, oh, we will only care about them because they're the big ones. But they do nothing. The main activity of a mutual fund is to have a team of people like Jan. They just sell, sell, sell. That's what they do. Not interesting for us. If we want to understand the risks and the returns associated with that, a mutual fund is of no interest. They take one risk, the index, And basically everything we want to know about a mutual fund, you will learn this afternoon in the exercise you're going to do. So I built essentially a hedge fund this morning. You are going to build a mutual fund this afternoon.